to a revolution like any other throughout the history of mankind. This is a wealth revolution, and it's going global. Did you ever think that you'd be able to benefit from the only real, time-honored investment mankind has ever known? Real estate. Real estate investing has only ever been accessible to a small percentage of the world's population. This is no longer the case. The wealth revolution means that wherever you are on your wealth journey, be it taking your first steps or taking off globally, you can join our global community, a community of real estate investors just like you. The Global Wealth Group is experiencing exponential growth, and wealth has never been this accessible. A truly global wealth revolution. We dream big, and our dream is to impact the lives of 1 billion people. 1 billion people. How will we do this? Through groundbreaking digital platforms that allow investors like you to take part in exciting real estate investment opportunities. These opportunities are waiting for you everywhere, anywhere, worldwide. Now you can invest in real estate with any amount of money, from the comfort of your couch or your internet device. Introducing our global brand ecosystem. Wealth Create, Wealth Migrate, Wealth University, the Wealth Movement.
So Lee, it's wonderful to have us all online, and over to you.
Thanks very much, Scott. And to our attendees, good morning, good afternoon, good evening, wherever you are joining us from. We are grateful that you have decided to spend the next hour to hour and a half with us. And in the hot seat tonight, discussing the future of value creation, I have our board chairman, Willem van der Post, and our CEO, Scott Picken. Thank you for joining me tonight, gentlemen.
Thanks for having us, Lee.
Wonderful to be here.
There we go.
So just before we get started, as you know, we are a community-centered company, and we like to know where everyone is from and for you to engage more fully in our webinar. But before we start that, I just wanted to share a partnership that we have with B1G1, Buy One, Give One. And basically, it is a partnership where we are able to give to those who are in need in various ways, shapes, and forms. And we have chosen 3 ways that you can contribute and give for free this evening with us through your engagement. So through anything that you do, any comment that you say, any question that you ask, we request that you please put a T, a W, or an E behind anything. This will mean if you put an E, you will be giving a day's free education to a child in need. If you put W, we will provide a family with clean water for a day. And if you put a T, we will plant a tree on your behalf. For every comment, every query, every question, we ask that you do this, because the more you engage and remember to put those letters, the more we can give on your behalf and really create an impact, because that is what we're all about. So on that note, we are spread throughout the world. We have Willem, who is in the Western Cape in South Africa. We have Scott, who is in Gauteng in South Africa. And I am coming to you from Guanacaste province in Costa Rica. So please do say hi in the chat box. Let us know where you are joining us from. And as always, the Q&A box has been activated. We really look forward to you drilling Scott and Willem and myself tonight throughout our webinar and giving us the questions and delving into everything that you want to know. So with that, I am going to hand over to Scott.
Brilliant. Well, I can see we got people here from South Africa, Jersey, Texas, all parts of the world, North Florida. So wonderful to have people from all over the place. Zimbabwe even. And tonight is the 4th webinar in our series of webinars. And each one of the webinars, we've been through some of the different areas. So this graph is quite a complicated graph. It's called the S-curve. And actually, it's the purpose of the entire webinar tonight. So I'm going to go into this with Willem a lot more detail. I wanted to remind everyone that we did a campaign on Cedars back in early 2019. We did it with Wealth Migrate. That was our B2C global real estate marketplace. Since then, we've achieved product market fit. We raised $2.5 million. And with that $2.5 million, we invested in building our tech, our digital wallets, our supply and our due diligence teams, and our global compliance. We dropped our minimums from $1,000 to $100. We grew our distribution through our partners, 83 affiliates, 13 channel partners, 7 strategic partners, and 2 country partners. We also have members now in 171 countries, investors in 69 countries. We've facilitated over $1.2 billion, and we've had $105 million go through the platform. And now we're ready to scale. And that is why the entire webinar is about scaling. We're going to talk tonight and go into this in a lot more detail. And there's three primary growth strategies that we actually have during this scaling process: one of distribution, one of profitability, and one of technology. There's also three phases to our business. We've completed phase one. We are now right in the beginning of phase two. And we're going to talk why this is important with regards to the scaling process. We're also going to explain the meta marketplace and how we plan to grow both organically with our own platforms, as well as through our distribution with our geographic partners and our genre-based partners. And then finally, if you take this slide, we started off in webinar one with the entire pitch of the business, explaining the overall business, how we've got our global alternative assets, we've got our technology, which sits at the center, and then as our distribution, we've got a B2C strategy, a business to consumer strategy, and a B2B strategy, a business to business strategy. Then in week two, we actually focused on how to scale through partnerships. And this was, all around the partner. In week three, we looked at our B2C strategy, which was all around our virtuous cycle. In week four, we're looking at the overall scaling strategy and how do you create value through the scaling phase. And then next week will be our final webinar, where we are going to be interviewing three incredible prop tech investors from around the world. We've managed to secure two incredible prop tech investors from America. We've got one from India, and at the moment, we've potentially got one from the UK. So we've got four amazing people that are in the space, authorities in the space of prop tech, to talk about the future of where this industry is going, prop tech and fintech. But without further ado, I wanted to move on to the core of the webinar tonight. And as Lee has already presented, basically what we're going to be doing is a conversation between Willem and myself. Now, Willem, I'm not sure if you want me to introduce you or if you want to introduce yourself, but I do think it'll be a little bit of benefit for people to understand your background. And let me know if you want me to do it or if you want to do it yourself.
Scott, would you mind doing the honors? It's always awkward to do your own intro.
Perfect. No worries. So, as I understand it, Willem was one of the younger partners at Deloitte. He set up their exponential division called Center for the Edge. And with that, got heavily involved with the exponential technology team at Singularity University and was driving really the exponential component and consulting within Deloitte, within large corporates. In 2017, he decided to go on his own. He's been involved in a number of different startups and scale-ups, but specifically got involved in his own venture capital firm, which is Simple Capital, in the last 4 years, where they've been investing in high growth technology startup companies. Willem and I have known each other since 2017. I was actually, he was invited as a guest to one of our strategy sessions in 2017. And at the time was consulting with a number of the big corporates as to how they become an EXO. We're going to talk about this tonight, but an exponential organization. And it was quite interesting because as he sat there, he said, I'll never quite forget it. I'd never met the gentleman before until he was sitting there that day. And he said he was actually fairly blown away to see that a smaller startup had many of the attributes of an EXO. And it took us quite a long time to get Willem to actually join. He joined the board in, I've got to get my dates right here, October 2020. And since then has had a significant, impact at a board level. And then in August last year, actually got voted in at the AGM as our chairman. And so I've been extremely grateful to be able to work with Willem, because it's been amazing to work with someone that truly understands how a high growth, venture-backed company works. And equally from not only the S-curve, but also an EXO, bringing in those attributes. And I think tonight you're going to experience that with things like the North Star metrics and a lot of the best practice that's out there from a venture building perspective. Now, that doesn't make traditional business wrong, but there's two different ways to play traditional business and kind of an exponential high growth business. So Willem, it's probably a bit more of an introduction than you were expecting, but just so that people get a context of how we met, what is your background, and more importantly, where your position is within the business at the moment.
Yeah, thanks for that, Scott. I maybe if you were doing my introductions more broadly, I'd have a mother-in-law a little bit earlier. Thank you. Nice to be here. I would just say this, perhaps as a quick segue. That was at a game farm when I got introduced to you and to this enterprise. And at that stage, I had spent 4.5 years traveling really around all the innovation hubs of the world, looking for not only technology trends that would reshape business. So if you think of, as an example, AI in the banking world, one example, there are many of them, and then to look for organizations that were harnessing what's called this EXO structuring. And at the time, it was weird to talk about artificial intelligence or exponentially growing organizations. And in Salim Ismail's work around what EXOs are and how they are structured, there are 11 attributes, all anchored in a purpose. We're going to talk through this slide a little bit later. But as I sat there, having just freshly learned this stuff, looking for them worldwide, here's this game farm in the northern part of Gauteng, where these guys have got this purpose-driven organization. And as they're talking, I can hear, oh, wow, they're ticking this, they're ticking that. We'll go through it tonight. And Scott, that's why I'd said on the day, just to give substance to your comment, that was a thought through comment. There's a real exponential opportunity here. It's about whether or not we are able to make it through the scaling phase. And you have to, as an investor, think of this like a rocket. If this thing is not bolted down and appropriately capacitated, the torque and the force of this exponential growth, is something that could be hugely lucrative, but if misappropriated in terms of how it's managed, equally destructive. And that's why in the scaling slide, real big opportunity is what I thought when I sat there. And that's why.
So Willem, can I, in terms of the whole kind of essence of this webinar series has been around scaling and the S-curve. And I'm not sure if you want me to stop sharing and you share your slides, or if you want me just to talk through it and you can just kind of ask me. But my suggestion is that we pivot into the S-curve.
Sure.
You have explained this to a couple of our shareholders in late October, early November last year.
Yeah.
But I think there's real value in people understanding this S-curve, the way that you've got this slide, the different stages of the business, the pros and cons of each stage, and also what's expected within each stage.
Okay, cool. Let's do it. I would just say to the audience, this is going to test me a little bit because I made this slide 9 months ago. So let's see if I really believed what I said. I think if you click once, it's going to bring up a blue line, which is the fabled S-curve. And ladies and gents, what you'll see, there we go. Thank the Lord. On the left-hand side, the axis refers to company value. So that obviously higher is better. And on the bottom axis, you've got time. So as time progresses, what you would want for a company to do in that first phase, perhaps, is to figure out what the hell it is all about, its product, its market fit. If it gets it right, to take on capital and supercharge that getting it right into not thousands, but if you're in a tech company, millions or hundreds of millions of instances of what you sell. And then at some point, the thing's going to peter out and reach a maturity, which is the top part of the curve. So that essentially, if you're doing this right, in a technology company that does go borderless, that is democratized, demonetized, decentralized, and digitized, you will find that its disruption to the market, if it gets it right, typically means that the company value looks like this. All right, so that's what we want. Obviously, the steeper the curve, the faster we experience our value growth. There is risk in going too fast, and I'm going to talk about that in a second. So Scott, let's try our luck and hit the next go forward, which will bring up
You
some
basically
more.
got the 4 stages. You got the startup, the scale up. Do you want me to just do one stage at a time?
Yeah, let's bring the 4 up and then pause there for a sec. So initially, when a company gets going, we've got that startup phase. So notice something interesting about the blue curve there. It starts off almost immediately with a value. And that's typically because there's a team, there's some IP, perhaps not already codified. And for investors that are new to the venturing space, vis-a-vis, you're not used to buying into companies at this early stage, it's messy. It's very messy. The lawyers would not have sorted out all the IP contracts, guaranteed. I can promise you there are going to be sales tax or VAT returns that are outstanding. There will be bank accounts that aren't reconciled. This is normal for a very early stage company because at the time, it's probably a guy with some PowerPoint and a couple of mates. And some other mates or family or idiots gave that person money, such as to be able to prove that there's something here that they've got going. Then actually value is destroyed for a little bit. So the IP might still grow, but we're sucking costs into this business. So on technical analysis, the business actually becomes worth less because it's like a black hole of cash. Then you make a sale, and then perhaps you make another sale, and then perhaps you make a sale to a person that had bought from you before. In other words, you now have got recurring revenue. And now you're starting to enter the space of where you're trying to grow a little bit. Perhaps some of your processes become a little bit more formalized. Maybe now you start employing a bookkeeper. Maybe now there's a lawyer that, gets half of his billings from you kind of thing. But you've proven gross profit capability. So unit economics are there. The market wants what you've got because they're coming back to buy it again. And you're doing so at the top level of your income statement profitably. You're still making a loss because your overheads exceed your GP because you ain't got enough of it. You have it per unit, but you don't have enough total of it. That's when you get into this scaling phase. That's where you get capital from someone else who's going to help you with almost institutional level fueling and funding of your business so that we can take those 10 or 11 transactions that you've done successfully on recurrence and do 100 million of them. Now, you can obviously see here at the bottom who's involved in providing you with capital at those different stages are different people because firstly, how they value companies is different. What they look for might be different from one another. How much money they've got is different from one another, and certainly their risk appetites are different. Example, on the very right-hand side, you've got large fund and corporate money. Very few C-suites will put their political necks on the line for returns in the sort of 40 to 80% realm. It's just too good to be true. And as we all know, risk is correlated with reward. So very few people that have climbed to the top of an organization after a whole career of doing that and investing into getting to the top is going to say, now let me take a gamble and put everything on stake. Similarly, if you think of pension funds, you don't want the underlying investor's money at risk. You want the stable, dependable return. So those funds and profiles are not going to come into a venturing opportunity per se. So you don't see them in the beginning. You see them later. Who makes the most money here? Well, that depends on if you get the blue curve right, because there's another curve here that we haven't shown on this slide, which is when that company goes nowhere or when it ultimately, has to declare bankruptcy and it crashes. Then making 3% in a pension fund looks great. But if you get your X curve right, for which there are measures that we can put in place to increase the probability of getting it right, then the average VC return over the 3-year period, 2018 to 2021, is 42% IRR. Now, bear in mind, 42% IRR includes everyone in the VC space. So those were the ones that failed and the ones that shot the lights out. The fail to shoot the lights out curve is not a bell curve. It's a left skew curve because more want to do this and don't know how to do it and get it wrong than those that do know how to do this and get it right. So that 42% is a skewed average. If you take out the losers, because we don't want to be in that conversation, then the IRR average for those that make it and those that make it great is extremely high. You're talking 80s to 150s. And so You get the blue curve right with the underlying investment, get enough of the underlying investments right, your curve starts to look really, really good with numbers that seem stratospheric. But of course, that's the appeal. There's the risk of that. It could go wrong. You could lose all the money that you put in. But at the same time, if it goes right, your returns are supercharged. And then we're going to talk about what this scaling in the middle means. Let's click through to some more artifacts on screen, Scott. Now that we know like what the company will go through and we know who typically gets involved in that sort of phases of the business. If you zoom out, what does it mean income statement wise? So how do we identify these companies? How do you know which stage you're in? And that's an interesting question to ask founders. Where are you on this S curve? A lot of them don't think about it. And typically, the very early stage ones here on the left-hand side, they are like maybe making GP, maybe it's single instances of revenue. The scaling part and a little bit before that is typically pre-profit. So you're not making profit yet. This is not a dividends play because you're burning cash, but it is post-revenue and typically post-recurring revenue. You'll see that the lines don't 100% align. And that's because early stage companies, as I had said, are messy. It's not a science. It is an art. And the entrepreneurs in this space are artists in themselves. And there's very little science associated with company valuation at this stage, which is why the investment structures are typically a little bit, perhaps to the less sophisticated investor, opaque. Then as certainty enters, returns start to decrease because now there's less risk because there is certainty. And on the right-hand side at the top, you'll see we talk about typically profitable companies. So there is profit to distribute. It's more predictable. The risk is lower. The growth is also lower and it yields dividends. And so the scaling phase is really the exciting one because the company has proven that it can do a certain service or a product profitably to the market. And now it's about how do we get it to do that? And if we get it right, then you can see we're not talking, as I'd said, those 3 and 4 and 5% returns. You're talking double and sometimes triple digits. Where's this group? Actually, it would be interesting to hear Scott say, as the founder of this group, like where he thinks it is. And this is a bit unfair because I didn't prep him that I'm going to do this. But would you agree, Scott, that where we've put that pink dot is kind of where the group is? What's your take on this?
Yeah, look, I think one of the questions we're going to get asked and have been asked, which we're going to answer later, is, we've said before that we were ready for scale. And I think I think probably most founders, when you talk about the art, probably think that you're ready before you actually are. One of the things where you've added significant value, along with some of the other board members that you've brought on, is that I'm now dealing with a board that actually understands the S-curve, understands what an EXO company is, and also what these different stages are, and have been helped me articulate, and not just me, the rest of the leadership team, and understand how to position ourselves for success. So like a great example was you separated out our B2C team and our B2B team, because up until June last year, they were all amalgamated into one team, and quite frankly, we're falling over each other. So, if you'd asked me, without your knowledge and without the insight that I've gained from yourself, I probably would have thought that we were further along the curve. However, after a lot of conversation with you and deep understanding, and particularly understanding unit economics and scalable operating profit, it became very aware to me that a lot of the stuff, and I've already mentioned it tonight, the tech, the platform, the compliance, the digital wallets, the supply, the due diligence, was all in place. And now it's all about throughput, whether we talk B2C or B2B. And so, yeah, I think where you've put us there on that curve is pretty accurate, in terms of that whole process. And yeah, we're definitely on the border between that kind of startup phase and that scaling phase.
Okay, great.
We're
aligned. Sorry, say that again.
No, I think we're in that twilight zone. We're in that kind of messy stage where we're not quite in scaling and we're not quite a startup.
Yeah, it is twilight. And Scott, I mean, let's just have a little bit of a conversation here. I think twilight will also frustrate the investors. You know, as the company grows and evolves, if it's doing it right, it will undergo a metamorphosis, like almost like, you know, caterpillar turning into butterfly kind of thing. And there are stages between caterpillar and butterfly that you don't quite know exactly, you know, is this going to be successful? What shape is it currently? And it becomes harder to box. And because it's harder to box, your expectations sometimes suffer expectation gap. So there's no one in a startup. There can be no one in a startup that expects dividends to flow from a company that's just started. Similarly, at the other end of the curve, like there's no, you know, listed that now hopes for a 15x on capital. You know, maybe I'm also getting corrected by the likes of Tesla and Starlink, but like there are very few of them because it is outside of the nature of the maturity curve. And the investors associated have got different mandates. So listed investors want dividends. Startup investors want capital return. So times money back coming out of startup and venture stage at some point switches over into the dividend play. The period over which this happens depends on how exponentially driven your company is. In our world, we see that this time at the bottom from left to right could be anything sort of 7 to 12 years. And capital to hold on, having invested, and then perhaps reinvesting on the Series A, the Series B, the Series C, the Series D, sometimes even up to Series very deep down the alphabet, can frustrate investors that have come on board hoping that soon, you know, this is going to be a return scenario. So I'm not saying there's no return. I'm saying know which investor you are, know what your underlying company stage of evolution is, and marry your expectations to those variables, failing which you're going to sit with an engineered expectation gap. And that's why there are angels, why there are VCs, why there are PEs, and why there are large mature funds that seek arbitrage or over-the-counter dividend type yields. So if this is where we are on that pink dot, and we both agree that that's where we are, then we're also at a fork in the road. So here is where companies put themselves on a course to fail, or they put themselves on a course to scale. And so where we are going, just on the next click, if I remember right, is obviously on the scaling journey. None of us are investing our time, our talents, our choices, our efforts into building a company that's going to implode. This is where we're going. Now you might say, as an investor,
sorry, Willem, there's one thing I just want to point out here, which I would like you just to refer to as well, is that you've got the typical S curve, and I have been asked by a few people, including our partners at Simple Capital, you know, if you're wanting to build a high growth company, then you go through this S curve. If you're wanting to build a lifestyle business, then you don't follow this. And I do think it'd be worth you talking to the two. Obviously, there's the third one, which is implode as well. But I just, you know, if you could just mention the difference between the two. Yeah, sure. That's a great point, Scott. Thanks, man. So lifestyle business, we see a lot of. Okay, so if I wear two hats here, right? I'm chairman of Simple Capital and chairman of Global Wealth Group. So let me just quickly wear my venture capitalist hat. The number of ideas out there is infinite. This is every guy at a braai that says, you know what we should do as a business, and then completes that sentence. It's the good idea in the shower. It's the daydreaming, perhaps in traffic. It's the lucidum intervallum on the bicycle ride. So ideas are plenty because they're very cheap. And there are a lot of talented people out there. Capital is abundant. There is a lot of capital in the world looking for opportunity. The thing that's scarce is talented people that can execute using the capital and harnessing the great idea and empowering it through that capital and their talent. That's the rare thing. So in the investment space, you're actually not really even looking for a business model. You're looking for a person that you can back to take you from founder and startup phase into this scaling. You're backing a jockey.
Now, sometimes the jockey is a globally minded person who will build this business to be in multiple jurisdictions, using systems and using teams in order to fulfill on that vision. And sometimes it's a very enthusiastic dude with a spreadsheet. In the global wealth context, a lifestyle business would be Scott, 2 or 3 administrative people, and him cutting a couple of deals every year. He's making sort of 5, 6, 7 million rand a year, but he's never going to go bigger than that. So he'll be wealthy, he'll be well off, but he won't be global and he won't be exponential. He's going to be a really nice, probably not have a roof on his car. The car will probably be red, or in Scott's case, it will be a faster boat. And but that's the limit of it.
I think you're defining where I was in 2012, 2013 with RPS.
So there we go. Now, here's the caterpillar turning into the butterfly. Scalability globally is now a possibility through exponential technologies and the use of digitized solutions, together with idea, capital, and talented jockey. But now the nature of the talented jockey shifts. It's no longer proving that there's a market or a market fit for a product. It now becomes building protocols and systems. So I can do 10 transactions with 2 admin people on Excel myself, but can I do 200 million transactions with Excel? That answer is no. Can I do it with 2 people? Definitely not. So I need scalable technology solutions and protocols and scalable decentralized teams to be able to reach all corners of the globe to get to those 200 million transactions. That is not a lifestyle business. That is a global business that'll be worth big money and big returns for the initial capital providers. This point where we are is the fork in the road to determine which way does the enterprise go. So where we are and where we are going, and the alternative to where we are going. Does that help color it in, Scott?
No, completely. And I think the last part to it, look, I've been asked by a few people, including an angel investor, if we had the intention of being a lifestyle business. I got asked it by Tim Willis, the CEO of Simple. And again, my attitude as well, if I wanted to, we wouldn't have gone through everything we've gone through in the last 7, 8 years, because we had that already. We literally had it in 2013. So why would we have gone through this? So, and it sort of ties in with the next slide, which is around EXO and purpose. But before we go there, what I do think is important is, on the assumption that, 100% we're going the scaling route, what are the, can you talk to the needs and often what happens in this phase, basically in the scaling phase?
Sure. So I'll just say, before I touch on the bullets there, what you need first of all is a plan. Scaling doesn't happen by accident. No one puts scalable, high-tech systems that are jurisdictionally unbound together happenstance. Just doesn't happen. So there needs to be a thought-out plan that has leadership around that plan to manhandle the execution of that plan every step of the way. This is where grit and scalable skill sets come into play. This is why you're backing a jockey, because this is tough. It is extremely, extremely tough. Think about it like this. The value of tonight's webinar. Scott is now out of the business for an hour. If the CEO of a big mining company that's listed is out of office for an hour, that mining company has already got scalable protocol. It's already international because it's listed. It continues. I sometimes wonder how long they can go without the CEO, if you actually need one at that stage. But if he's gone for an hour, the company doesn't even flinch, doesn't even blink. If a startup founder or a scaling founder is out of office for an hour, that hour means so much more by virtue of the role that that person plays inside of this phase of that business. So appreciate where we're coming from and what it takes to do this. This is not a 9-to-5er. This is a live, breathe, think about, argue about, impacts your personal relationships, impacts your personal finance, impacts your health, your wellness. This is an all-encompassing thing, which means the jockey needs to be golden. I cannot stress that enough. In the VC space, it's like human capital recruitment before it is business model. Having said that, if you do now have this appropriate jockey and leadership team, then they need a plan that can be followed and executed. So number one that I should have put on the slide is plan. Then typically in businesses in this phase, at this crossroad, there's a need for capitalization. You cannot go from 2,000 transactions to 200 million transactions. I'm using arbitrary numbers, but you cannot do that sort of scale step change without money to throw at the problem, i.e. a scaling funding plan. So it's not just please put money into the company so we can pay day-to-day expenses. Day-to-day should come out of GP. This money is to build the difference between 2,000 and 200 million transactions. It's the scaling capitalization. So you need that. Second to that, you need people that think scale and that have skill sets in building scalable solutions. Discipline and frameworks, because you can get carried away if all this money is coming into the company. You can very easily lose the focus of the vision. So there's framework and discipline associated with that. And then a thing which I saw when I met Scott first, which I think we have in this organization, is investor activism and evangelism. In other words, it's not people that put money into the company of the Global Wealth Group, but don't buy its products. They are participating in buying the products. They believe in the product set so much that they actually want to invest in the company, not the other way around. So to have that community that you're able to engage, that gives you feedback of what works, what doesn't, to help you with greater market fit is absolutely critical. What we don't want is passive investors that never engage the company until something goes wrong. We want that as well. But in addition to that, we want activism and evangelism. We need it. And then perhaps, Scott, just on the things that I often see, what happens, this one sometimes is tough. Bear in mind that if a startup is all-consuming to the point that it touches all those aspects of your life, it's your baby. You're going to have an emotional bond as the founder with an organization that you've brought about. Specifically, if you've stuck it through the value destruction part and you're now at the precipice of scaling and you don't just want the lifestyle business, then we often see that the skill sets and the evangelism associated with building the initial part of the company is a very different skill set from those that propel the company into scaling. And I don't like quoting pop culture, but even a guy like Steve Jobs had been at Apple and collectively built the startup phase, and then he was actually fired because he was so wrong for the company at the scaling phase. The fact that he came back later with an apology is often the thing that gets focused on, but bear in mind that he came back to a company that had been functioning and that had instituted protocols around being stable in its delivery of product. And that is not to be ignored for the sake of having a romantic story around one guy that made it, because it wasn't one guy. I can guarantee you that it was a group of people that needed to do this, and it necessitated a leadership change. And what we often see is that the founders hang on with, white knuckle death grip. It's like being in a whitewater raft on the third rapid of the Zambezi. It gets hectic and it gets thrown around. You see people hanging on for dear life, white knuckles. And often in this transitioning phase, we see white knuckles from original founders. And if the white knuckles persevere, you find lifestyle business or implosion. If the white knuckles let go and bring in this scaling skill set, then everybody stands to win. And this is a super, super, super important point. We often also see, so what started as a way of conducting your business, you're still in that business, but your need to reorganize becomes pronounced because you're not getting into that scaling phase. You've just proven markets. So reorganization often happens. And then, interestingly, you see those 3 T's and then the 2 T's. The 3 T's are what normally happens in a large, stable organization with talent. And if you have a talent performance issue, it's You train, or you transfer, or you terminate, in that order. So if someone is unable to do their job, or do well enough, you give them training, and there's corporate budget available for that. If that doesn't work, then you got to transfer them into a role where they have appropriate skill sets from which you can get economic value. And if neither of those work, it means you can't train the person. They also don't have another spot where they can function for you. And so you've got to go the termination route. In the scaling phase, a very little time to train, because we're burning cash of investors that are wanting to get up this curve. And we have a fiduciary duty. So no time to train and learn at other people's expense. So you often find that what you're left with is transfer into a different role or terminate as the only two practical talent opportunities. And that's scary. People's livelihoods are often pegged to these organizations, and it's emotional. And one of the things that I see in my VC life is this transition phase. It's tough. It's not for everyone. However, if you do get it right, to the last point there, what you very often then see in getting this right is even greater swells of enthusiasm, investor activism, and that evangelism that I'm talking about. You tell everyone at your braai about the fact that you're invested in this company and that you're using their products because you so believe in it, and you can see this scalability that's busy taking place. And there are metrics that tell you how well it's going. You've got those metrics and you're saying, wow, the S curve is real for me. And that, with a whole bunch of assumptions around stuff that needs to get right and a whole bunch of blood and sweat that sits behind getting it right, is how you want your venture investment or your early stage investment to play out. Scott, in my humble opinion.
Willem, just talk to us before we pivot to the EXO business. Something that I learned years ago, I had a lot of challenge bringing it into the board, and you've now brought it in successfully, which I'm truly grateful for, is the whole of the star metric and how important it is, where you've kind of got one metric that everyone's focusing on, to achieve. And obviously there's output metrics, there's input metrics, so you got one metric and multiple metrics tie into that. But just talk a little bit about the North Star, because I think it's probably one of the most important things, if people can see my curve, in getting to here and getting team alignment up the scaling curve is the metrics. Because you said that even for investor evangelism, they need to be able to talk about the metrics and the growth.
Yeah, perfect. Okay, so as I said, this is an art, not a science. Although frameworks and disciplines have emerged, which you can apply scientifically. The problem with scaling businesses that are in this phase is that their income statements look weird because they haven't got EBIT. They've got negative EBIT, typically. As I said, they are spending money on acquiring market share because that's that 2,000 transactions to 200 million transactions phase that we're talking about. That costs money. It costs marketing money, it costs tech money, it costs team money. And so you end up with a negative income statement, but massive value creation. So it's hard to measure on the income statement, which is the normal private equity, the normal over-the-counter, the normal listed share methodology, is something to do with the financials. And then here, we're not looking for the financials because they're telling a negative story. We're looking for a metric that shows the investor that growth is busy occurring. In other words, that we're climbing this S curve. So if you imagine, think of Uber. And again, I hate quoting pop culture, but just for a second, bear with me. What would be a good metric in the early stages? Let's say Uber was where we are, right? On this pink dot here at the bottom. What would have been a metric for Uber? It certainly would not have been income statement metrics. You could argue maybe revenue. And now we've lost our background. Here we go. Yes, choosing a North Star metric.
I'm just bringing it up for everyone, this article that you shared, which is brilliant, and I'm putting in the chat box for everyone.
Yeah, I was about to say, let's put the link in the chat box. That's a great idea. It's about a 4-minute read, this. Essentially, if you just go back to our curve illustration, at that stage of the game, you probably want to see how many rides have Uber provided to people, just the number of rides. And if we're going from 2,000 transactions to 200 million transactions, then we can say, okay, we're obviously gaining market share, popularity, greater market fit, and expansion. And that's what we want, so that when we turn off the growth acquiring phase of the business, all of that cost disappears and drops through to the bottom line, which then give you this mature business that grows at 8 or 9 or 10% per year and provides dividends. So then the question is, what should be the North Star metrics for Wealth Migrate and Wealth Point, Wealth University? So the thinking is, Wealth Point is a software platform. It facilitates alternative market equity raises. So clearly its metrics should be equity raised. And every month there should be a report that's out very soon after month end telling investors, this is the equity that's gone through. How does that tie up to the targets for the year? And do the targets for the year tie up to the thing that I opened up with, which is the plan? So you can see all of these elements are now starting to form this harmony of like an orchestra playing the same music piece. And no longer do you have a guy showing up thinking that he's a rock star, another guy thinking that he's a classical pianist, and another person doing the rumba. That should all be the same music, playing off the same sheet, trying to make the same harmony. These plans should be synchronized. The North Star metrics should complement that. For Wealth Migrate, my personal belief, number of transactions. For Wealth University, how many enrollments have we driven? And the good news is that internally, we've now gotten to a place where the leaders for each of those functions are solely responsible for achieving those numbers, and they are empowered to achieve them. And they know what they are, and they've agreed to them. So we now have a willing and able orchestra wanting to play this music. And so that's why we're in this capitalization or capital raising phase, to put that fuel behind this plan and this team. I think I might have jumped the gun a little bit there on that last bit, Scott, but I hope that covered North Star metrics.
No, awesome. Listen, I'm conscious of time, but it's incredibly valuable. So that article, just for everyone, I've shared this article, and you can actually see there's 6 broad categories for North Star metrics. And you can, again, I'd highly recommend reading this, and it's been incredibly invaluable for our board and for our leadership team. And to be honest, for me as an individual, it's the value you bring, not only but at a chairman level. It's wonderful to be dealing with people at the board that actually understand S-curves and growth companies and are not trying to build a traditional lifestyle business. So it's quite a nice way to pivot into an EXO. And I know we've done webinars before on this, Willem, so we don't need to spend a huge amount of time on it. But if you were to take the kind of the S-curve and overlay it with kind of the principles of the EXO, my understanding from what I've learned from you and others is that there's a lot of synergy between the two, because you really need a lot of the attributes of an EXO to build a truly scaling company. And equally, to scale, you need to be able to focus on the EXO. What are kind of your thoughts of not only these 11 attributes, but how they relate to scaling?
So Salim Ismail has published what's probably the best read business book ever. He did the research 2013-14, published 2015, and it's called the Exponential Organization. And the premise of the book was some companies are killing it. Think Uber, think Airbnb, think Google, think YouTube, more recently SpaceX, Tesla, GitHub. There are literally hundreds of them. But what do they have? Why do they get it right? And whoever the hell is second didn't get it right, or didn't get it right fast enough. And so obviously, if you can get that right, you can sell this to companies until you fall over one day. And so this essentially became the framework of what was found. There are 11 attributes that, if you structure these attributes into your company as a way in which your company conducts itself day in and day out, have the potential of you reaching exponential growth and unlocking that S-curve, and probably pushing the S-curve a little bit more steep. And then there's an interesting thing. If you have 4 of these, typically your results start to become exponential. Growth, the output disproportionate to the input of what it costs to make that output. That's essentially the definition of an exponential organization. And then the research showed something super interesting. We couldn't find any EXO or exponential organization anywhere in any jurisdiction that didn't have an MTP, a massively transformative purpose. Because without that, you've got no North Star on which to base your North Star metrics. Without it, you are rudderless, you are leaderless. And so you can have great technology and wonderful people, but if they're not playing the same music, you've got noise, not orchestra. And then other of these, Scott, I don't think we go into each of them individually, but I'll just quickly do maybe two to show this is not rocket science. It's just the discipline of deploying this, which for some reason in the world is not there. Maybe it's too tough to climb this mountain. I don't know, but there are few EXOs out there. Now, obviously, more and more are starting now that the book has been published and people know what to do. So, for instance, I'll take a super, super easy one. Algorithms. Clearly, using an algorithm to do a yield calculation for a property is a lot more efficient, a lot more accurate, and a lot more scalable than having a team of people do it. So EXOs, where they can, use algorithmic interventions and solutions as opposed to raw human talent. So straightforward and obvious. Another interesting one is autonomy on the left there. So autonomy refers to the fact that you can make a decision without having to go through red tape to make that decision. Now, the only way you can make your own decision in a large organization is if you know what target you're trying to hit. What target you're trying to hit is coming from your massively transformative purpose. So you can see how this Rubik's Cube is sort of sticking into each other, and these attributes at the bottom, staff on demand, community crowd, algorithms, etc., are all complementary and leveraged by the fact that you've got a clearly defined purpose, which again is your leader's responsibility to continuously communicate and drive throughout the organization. And if you get this, then your ability to unlock that blue curve becomes real. And the more aggressively you pursue these attributes and implement them, the steeper your curve typically becomes. We're busy conducting a study now in the MBA class through University of Joburg around the financial correlation of South African and time zone companies relative to how exponentially structured they are. And the prelim findings are marrying this. There's almost a direct correlation between the two. So get this right, get to be a butterfly.
Willem, there's one point I just want to say here where, you know, again, when I first met you in 2017, I think I understood these principles. I read the book. My board at the time, I tried to make the book compulsory. And the best analogy for that is taking a horse to water and then holding it and like drowning its head under the water. And what I'm really enjoying now, working with yourself and the other board members and the rest of the leadership team, is that this is no longer a fight as to whether this should happen. It's really a case of, you know, knowing this needs to happen. However, also acknowledging that, again, we're only at the very beginning of the scale age, and that if I gave us a score, I would say we probably, you know, only 2 out of 10. And why I say 2 out of 10 is I still think that there can be a huge amount of growth, particularly within the leadership and the different business units, to really enhance these different things. Like, yes, we've got a number of them in place, but they can be much better. And with more understanding, there can be, you know, more focus on them. But I do think that from your perspective as chairman within the board, you've started to help bring these things in. And the North Star metrics, just a classic example of that, where it's all good and well to have dashboards on the left. I mean, we've had dashboards since 2015, but if you've got, I don't know, 15, 20 things you're looking at, it's all just confusing versus, you know, having that one North Star metric. So yeah, you know, for me, I just wanted to acknowledge that I think we have pivoted from a place of theory to a place of practically implementing now, and also acknowledging there's a long way still to go.
Well, you can only get a horse to drink water if it's thirsty and it wants to, right? So
brilliant. Let's pivot on. I'm conscious of time here, so I want to just take some people through some concepts. So I did mention in the first webinar, if you want to go and look at it, you can look at the overall pitch. You can understand the business and kind of where we were going and what we were doing. In the second webinar, we had some great guests. We had Lyndon Booth, who is our product management officer in Wealth Point, and he explained the whole concept of value versus leverage. And really, over the last 3 years, we've built this significant value, and now it's all about leverage. And one of the things that I know has resonated with a number of our shareholders is that if you take UberX as an example, or even Uber, they built Uber Black first, and then they leveraged it. And then they built UberX, and then they leveraged it. And now you've even got Uber Eats, and they leverage it. So each time you create value, you've got to leverage it. So we've been in the value creation phase, and now we're very much in the leverage phase. If you look at that leverage, if you look at the platform, what few people understand, and it's interesting because you spoke about 2,000 to 2 million, our platform today can do 15,000 transactions per second. And that really becomes quite significant because some of the partners we're talking to in India at the moment, and we're currently trying to onboard 3 partners at the moment, one truly represents the scale we're targeting. They've got 1.15 million high net worth investors, and they've got 60 million retail investors. And one of the questions that got asked on that webinar was, would you be able to, would your platform be able to handle the scale? And Lyndon very eloquently said, well, we can currently do 15,000 transactions per second. Now, to put in perspective, last year we did 1,000 transactions in a year. So that's what I mean by value versus leverage. The platform can take a hell of a lot more throughput. If you take Sharia Wealth, 5% of financial products worldwide are Sharia compliant. 25% of the world's population are looking for Sharia compliant products. There are 200 million Muslims in India alone and 7 million in the UK. And this sector is currently growing by 12% a year and is expected to grow to 5 trillion by 2020. So just 2 of the strategic partners we're dealing with, both Wealth India and Sharia Wealth, have huge potential to scale, and we call them anchor platforms. Then we went to week 3, where the B2C team very eloquently spoke about the virtuous cycle. And a lot of us heard about the flywheel concept from Amazon. And ultimately, it's about growth. It's about customer experience, getting more traffic. If you get more traffic, you get more sellers, which ultimately means you get more selection. The lower the cost structure, the lower the prices. Basically, it's better for customers. It means you get more customers, and it's a flywheel that goes on. Now, I'm not going to go into this in a huge amount of detail because we did an entire webinar last week, and you can watch the recording. But what Murrican took us through is that the Global Wealth Group, we've got the technology. It's all about the growth. We're launching active marketplaces. We've got an entrepreneurial community, and it's all about creating more transactions. We've got an entrepreneurial ecosystem. It's about more traffic and transactions, and ultimately that will lead to more deals. If you look at it, in a more visual concept, you've got both our geographic platforms, our genre-based platforms, and even our organic growth. And they all feed into the cycle. Then at a Wealth Migrate level, which is purely our B2C, it's about our customer experience here. It's about traffic and getting more members onto the platform. Ultimately, it's about more transactions. If you've got more transactions, that'll offer better quality supply. You need more accessibility, so consistently dropping the minimums down, and then more deals, so more variety. So more supply, more deals will get you more customers, and it's a ever-growing cycle. And then lastly, a question that I get asked all the time is that if you take GWG, you've got the B2C side on the one side of the fence and the B2B side on the other. You've got the wealth movement, which is all about the community. So the North Star metric there is members. You've got the education, which is Wealth University. And as Willem said, that's about subscriptions. And then you've got Wealth Migrate, which is about, transactions. And, again, I don't have time tonight, but there's 2 levels, belief and knowledge, which the members get through the Wealth University. Then levels 3, they get access to the system and investment. And then ultimately, there's some investors that from members go straight through to being investors. And ultimately, it all goes back to community, which is accountability and results. So it's an ever-evolving graph. And then on the Wealth Point side, we've got equity, which is the business side of the business. Now, when we look at the value creation for shareholders, I don't know, Willem, just jump in if there's anything you want to talk to, but something you and me have been talking about is setting a goal of a share price greater than $10 per share. And when we look at how to do that, it's basically that we're aiming to do 1 million transactions per year through the platform. So through the multiple platforms, the meta marketplace. We're looking at an average fee per transaction of 5%. So that's monetizing the buy and the sell side. and ultimately with an average transaction fee of $2,000. Now, these are the kind of the North Star metrics we're looking at. And at a minimum, from a shareholder value perspective, our goal is to be greater than $10. Willem, anything you want to add to that before I move to the next slide?
Yeah, 100%, Scott. Thanks. Caution. Share price quoting in a business that is not listed creates expectations. And I support a high share price value as an aspirational goal. But as investors, we should also know that this is a company that is burning cash in its scaling endeavor. And therefore, traditional methodologies around valuation are tricky at best, slippery at worst. So the focus for me is around the attribution of value that we unlock by virtue of achieving these North Star metrics. That for me is the true test as to, are we doing better or are we doing worse? And in the end, that will lead to this goal that you're saying. But in the short term, let's focus our evangelism and our activism around the attainment of velocity in those North Star metrics.
Yep. No, perfect. And that, that's the alignment that you've helped bring in, not only through the board, through the leadership team, through the different business units, so that we've got that alignment to focus on the velocity. And again, another word for velocity for me is leveraging. It's actually leveraging the value of the platform, the compliance, the regulation, the supply that's all in place, the digital wallets, etc. This is a question we get asked quite a lot. How can shareholders create value within the ecosystem? So the first is, Willem's already mentioned it, actually use the platform and engage. The minimum investment now is $100. If you're a shareholder, go online and actually use the platform, get started with $100, actually see how it works, give feedback, etc. So that would be very valuable. Share the platform with others. That's the investor evangelism. Introduce us to partners. We've got over 1,000 shareholders now from 42 countries, and we're always looking for quality demand partners. So one of our shareholders in South Africa actually introduced us to our partner in India, and everything that's happening in India is due to that shareholder. We call them a wealth partner, but that shareholder that's based out of South Africa. And that's a full demand partner. And then obviously we got supply partners, and we got a number of very sophisticated investors in the property real estate space. And we're always looking for quality supply partners and other alternative assets. And then the fourth one is be an active member of the overall community. So the wealth movement community, and really helping us drive and grow that. So the four ways that shareholders can create value, not only for themselves within the ecosystem, but equally, if we're doing that, we're helping each other. Willem, I'm not sure if you want to jump in on each slide in terms of how you want to take it.
There we go. I think the main ask is be involved. I say this in my exponential expose often. Often adults get to the point where perhaps it's easier to complain from the comfort of the couch than it is to be involved in actively driving solutions. Positively inclined people that see opportunity will obviously be in the latter. But the world is in a weird place right now with wars and this virus. And so a lot of people are in a negative space. I will implore you to bring positivity to our ecosystem. The purpose of this company is really great and serves the world at large if we get it right. Help us get it right. Help us spread the word around what we're trying to do here, and the successes and the learnings that we have out of trying to do this. In other words, this is like being a Western Province supporter in some ways. You can't just enjoy being a Western Province supporter when they're winning. You got to be behind the team. And we ask for that support when we're looking for talent, when we're looking for deals. If you think that there are interesting alternatives that we should consider in the way that we do it, we're not a closed company behind a locked set of doors. Certainly from the culture that I'd like to foster, there's openness and transparency. And so look forward also to sharing investor newsletters that have, amongst other things, these North Star metrics on a more regular basis going forward. And perhaps I'll leave my soliloquy at that, Scott.
Perfect. why do we think we're ready to scale? And I think to some extent we did answer this. I've thought that we were ready to scale a few times, and I have made mistakes. In 2017, we looked to launch Dubai, Australia, England, and America in the year of 2017. And yet once we started putting throughput through the platform that was built in those days, it just fell over. And it's interesting because I'm embarrassed to say this, Willem, but what you said earlier was the reason being is it looked quite nice on the outside, but on behind the scenes, you had a bunch of people running around managing spreadsheets. And so the moment you put throughput through and, didn't have necessarily the right policies, procedures, etc., it just wasn't ready for scale. And so, Gavin and Lyndon and the rest of the tech team really deserve a lot of credit. And they started kind of mid 2018, late 2018 to build out the technology. And only more recently have we now built a truly scalable solution. We then brought on the compliance, the regulation, the digital wallets, and most recently the supply, the chief investment officer and Rian van der Pfeiffer, etc. And so, unfortunately, a number of the pieces of the puzzle weren't in place in the past, and I thought they were, but when they got stress tested, they weren't. And so for me, when you look at it and you look at the phase of the business, you look at the tech, the compliance, the digital wallets, and the supply all being sorted. Now, really, it's the scaling, with the throughput, and as I've said already, but leveraging what we have. And I just want to, I'm not going to spend too much time on this because we've spent an entire webinar, which was webinar 1, talking about this. But phase 1 was all about high net worth investors. We started at $100,000. We worked our way down to $1,000, but it was all trying to figure out how to scale in tech, banking, compliance, etc. Phase 2 was really where the scalable operating profit came in, and this twofold strategy of growing the operational platforms and the venture building, which is through venture building through strategic partnerships, be that geographic or genre. And that literally started, WealthPoint started doing that in the middle of last year. So it was June, July of last year. We're looking to get on our first strategic partners, etc., in this process. And phase 3 is a whole nother phase where it's a combination of local and global, but that's a good 5 years away in terms of the process. And this is why we're in phase 2 in the scaling process. And really it's about the unit economics and scalable operating profit that are so important. The revenue model, I think we've explained enough, where it's all about transactions. So there's transactions from the suppliers, there's transactions from the investors. So like we said, there's demand and supply, and there's an investment as a platform service that we earn in the B2B space in terms of how it actually works. But to use Willem's analogy, Uber earns a transaction every time someone catches a ride. Airbnb earns a transaction fee every time someone uses a bed. We earn a transaction fee every time the platform is actually used. Why are we raising on Cedars? This is a question I get asked a lot. And the first reason is that as a platform, to our knowledge, they're the platform with the biggest reach. They've got over investors from over 80 countries can actually invest. A good example was in 2019, a gentleman in India called Rohan Malhotra came through. They're a very well-known family in India. They make something like 90% of the razor blades in the world. And along with our partner on the ground, Ishanand, who's actually online tonight and did a brilliant webinar in the second webinar series, they are working closely to figure out how we launch India. But you've actually got a partner on the ground that's invested and you can trust because they are a shareholder and they've got the best interests. At a global community level, as I said to you, we expanded to shareholders in 42 countries. What's also interesting is that it's quite a low customer acquisition cost, because the lowest amount that you can invest on Cedars is $10 or £10. And, so it allows you to reach a huge bunch of people, let them know about it and actually get them to use the platform. And one of our frustrating things with the UK at the moment is because of the Brexit, we lost we couldn't help UK investors. So we're currently getting our FCA regulation. And as soon as we do that, we can actually help our UK investors. We can really help European investors. And then for those countries like South Africa, we had someone this morning from Australia, where there are countries like South Africa, Australia, etc., where you can't invest on the Cedars platform, then we still use it as a catalyst to be able to go with it, but we just help them off platform. And it's quite important when one looks at it this capital raising line, because a number of people say, oh, but you're only raising £750,000 or roughly $1 million. And we go, no, we've got an entire plan that was put together with Simple, where we're looking to raise, $1 million prior to Christmas, which we did. We're then looking to raise a further $2 million over the next 6 months. So a total of $3 million. And that will set us up for success to go through to really where we want to go to the priced equity round. But as I understand it, you want to go to the priced equity round, having all those metrics, all those North Star metrics trending in the right direction. And then you go for the institutional investment at the priced equity. So the Cedars part is a piece of the puzzle, and it's really important to understand that. In terms of how are you going to scale, I hopefully think we've explained this tonight, but there's a dual strategy from a distribution where we've got organic growth of our own platform, Wealth Migrate, and then we've got strategic partnerships, which is our B2B. We've then got profitability, and that's all about our scalable operating profit. So that's increasing our metrics, increasing our members, increasing our member conversions to investors, decreasing our cost per transaction, and ultimately increasing the profitability per transaction, and then investing in our technology and continually aiming to simplify. So the slide that's in our pitch deck that explains that is this one. And as you can see, we've got our distribution, our profitability, and our technology. When one looks at the overall marketplace and what we're trying to achieve, you can see our technology is sitting at the middle. We started, we built the technology for Wealth Migrate. We then built out the Wealth University and the Wealth Movement. We launched China in late 2016, early 2017. We then did a private equity for Genius U that is currently listing on the New York Stock Exchange. We did a wide label for Zuza, which is a UK developer in the UK. We then did a structured note for the Cashbox team, and that's when we realized we could move out beyond just real estate into other alternative assets. And then we launched our private offering, so the difference, kind of think of it like economy class and first class on an airplane. And we launched a little genre in yachties and wealth. And that's kind of where we got to at the end of last year. This year, our two key focuses are Wealth India and Sharia Wealth, getting both of them up and running. And then with time, we'll bring out South Africa, we'll bring out Women in Wealth, we'll bring out other geographies, other genres, and even the plan is next year to bring out Wealth Create, where the minimum investment could be as low as $1. So what is the use of the funds and what is the total investment? As I said to you, it's a $3 million investment. The minimum investment off platform is $10,000. If you invest through Cedars, it's literally £10. And you can see that the distribution breakdown, 21% is going to the profitability initiative, 29% the technology, and 50% is the distribution. So it's really leveraging the technology that we actually have in terms of where we are, basically. And again, this is in the pitch deck, but if you want to go into it in even more detail, you can see the 21% is about the scalable operating profit, the 29% is about WealthPoint and the CapEx, and then the distribution and the breakdown of how we're actually using the funds. And then lastly, in terms of please explain to me the opportunity, we tend to find that there's three reasons why people become a shareholder. The first is that they want to make a profit. The second is that they want to invest and be part of a global like-minded community. They want to grow with the aspirations of being a global citizen. And the third is that they want to be part of both a profitable and purposeful endeavor. So Willem spoke of an MTP, a massive transformative purpose. I believe that we've got a very strong massive transformative purpose in, we're aiming to help solve the wealth gap, by empowering everybody to be able to invest like the top 1%. And so these are the three reasons why shareholders have become shareholders in our business. And if it resonates with you, then my recommendation is to either go to Cedars and read more or speak to one of our team members. Willem has eloquently shown you where we are and where we're going, and that this is the greatest part of the value chain. Often in a ranked startup, there's a lot of risk and not a lot of growth. And, in this stage, it effectively, the growth kind of peters out because it becomes a lot more predictable. This is where we are, and that is our ask, basically. In terms of our discounts, it's quite interesting if you understand how a safe note works, which I'm going to explain now, but there's different thresholds and there's different discounts, anywhere from 30% discount. And what does that actually mean? Well, a safe note is a very trusted way of doing it, particularly in the venture capital space in America, where it's a legally binding instrument. It's widely adopted as the go-to instrument in early stage funding. The valuation is actually deferred until the priced equity round, which significantly reduces the fundraising timescales and the costs involved. And it boosts investor returns because you get an immediate valuation uptick at the priced equity round. And if we look at this illustrative example, and again, just to be clear, this is just an indicative post-money valuation, it still has to be determined. But if someone invests $50,000, they get a 25% discount. And, if the business is valued at 25 million, that means that the 5 million will be raising 20% equity. That's 2,500 shares at $2. Whereas the $50,000 investor will get 25,000 shares at $2, but the safe note investor will actually get the discount. So they'll get 33,000 shares, and they're immediately getting that uptick. The difference between the priced equity at 25,000 and the safe note at 33,000. So they're getting that automatic uplift or uptick that takes place, generally within a 12 to 24 month period. And to finish off, when one looks at it, just some of the positives, 75% of the money came from our follow-on investors. We've got a large prop tech syndicate. There's actually 4,000 prop tech investors called Jonathan Wasserstrom through the AngelList syndicate that is investing. We've got Simple Capital that we're working with closely through this Cedars raise, and then on to, with the intention later in the year for the priced equity investments. And a lot of people also asked, why are you doing a safe note? Why not just a traditional investment? I have explained really the benefits of safe notes, but for us specifically, it's so that we can scale out our partnerships, we can get those North Star metrics working, and we can also get our global compliance in place with our FCA license. And then lastly, what's really nice within the Cedars environment is that you also get perks. So as an investor, even at £10, you're going to get access to the investor test. Depending on how much you invest, you'll get access to our wealth hacker community, which is our annual subscription model. You're going to get discounts on investor fees, and you even, depending on the levels, can be involved at an investment committee level. So that's for you. That's the benefit of what's in it for me. And at a purpose level, you can also gift to others. You can gift to them the investor test. You can gift to them the wealth hacker community, and you can even gift to them the starter pack so that investors, you can actually get people started. We believe it's the greatest gift you can give anyone is actually education. And then Lee has already mentioned that we've done a partnership with B1G1, and for every investor that invests, we'll give at least 1 day of education to a child that is in an emerging market. So you can go read all about this on the Cedars platform under the perks. So if I go here quickly and I just go through to Cedars, you can actually see all about it. We've now got 314 investors. We've got 13 days left on our platform. You can go read all about it. You can watch our investor video, et cetera, et cetera, et cetera. You've got the key information, and you've got the investor perks, which is all here. And come and be part of the conversation. Come and ask us questions. Come and ask for documents. You can see the investors, et cetera, et cetera, et cetera. So to close out, if you've got any questions, please get hold of Alex at invest@globalwealthgroup.com, or Luke Bolton that comes from Simple Capital. He actually worked at Cedars for a number of years, so it's really valuable to have him both on the venture capital side, but also with a deep understanding of Cedars. And we're happy to help. And Lee, what I would ask while we go through the questions on Q&A is if you can put up the survey. It's always very valuable for people to give us feedback on what they found tonight. And I hope, Willem, you don't mind if I can see there's a couple of questions coming through, and we can just answer them as we close out.
I love that. I've got a hard stop at 9 with other commitments.
Cool.
Great. Well,
okay, Lee, while we've got the survey up, do you want to jump straight into the questions?
Yeah.
Specifically, maybe focus on ones for Willem, and then I can answer if Willem has to jump.
Yeah, great. So thank you for your time, both Willem and Scott. Willem, what is the greatest step forward you have seen in GWG since accepting the position of chairman? And what has been implemented to set the company up for success?
Yeah. I think the greatest step forward has got to do with culture. So we had to reconstitute the board to get scaling skill sets into place. And by the way, we're not done with that process. But that, amongst other things, meant for some individuals to step off this board, which the individuals involved did voluntarily. In fact, I think they were quite happy to be able to position themselves focusing on operations. And I think it could have been easily mismanaged into a state of fighting as that transition of phases happened in the company. So I would just say there's a willingness here to learn. I get the sense that everyone's heart and focus is in the right place. And if we're able to calibrate the plan and then put some frameworks and disciplines around doing that, we've got a real shot of taking something that's been brewing for a long time and turning it into actual value. As I had said, you back jockeys, first and foremost. And yeah, with a couple of repositions and changes, I think we can make this work. There was a second question, which please just remind me.
What has been implemented to set the company up for success?
First of all, focus. We've got a Renaissance plan. So what was a company that had multiple purposes combined, where most people sat in most people's meetings, has now been disaggregated into specific value pillars that from a statutory perspective will get into separate statutory companies that are all 100% owned by global wealth groups. So no one's going to lose value, no one's going to lose traction, but we do need to mobilize individually. So we've split companies into separate reporting units. Our next step is to actually put them into separate statutory entities. We've empowered leaders to be able to take charge of those underlying opcos. Where we didn't set their budgets, they set their budgets working from the bottom up. So we've got something that we know that we can hold them accountable to, which they want, but also that they are empowered to, where the board helps them as opposed to instruct them. And that in itself is quite a fundamental change within the Global Wealth Group. You've now got empowered leaders. And then what are they empowered to achieve? The North Star metrics on which we've agreed. So look out for that investor newsletter that we'll publish on the quarter, such as to be able to track this so that it's not just my word saying, I think there's traction. We have measurables for that traction now, and teams and ops and systems can align with that. So in other words, a measure to track that implementation of success, which is critical. Otherwise, it's just storytelling. Thanks for the questions. Good questions.
We've got another one for you, Willem, seeing as you're popping off shortly. Although the S-curve has a steep incline, how long do fintech companies usually take to move through the scaling phase?
That sounds like a investor hungry for return, which I can understand. It's different for every entity. There's no, at this stage of the game, if you Google time to become unicorn, what you'll see is that over time, companies have started to do it faster and faster by virtue of utilizing exponential technologies. The time that it took to go to $1 billion valuation for companies used to be sort of 50 to 60 years. Some companies have done it in 3 or 4 months nowadays, and everything in between. The exceptions lie to the short side, and the average lies to the right-hand side. In the VC space, I can just comment broadly and say somewhere between 3 and 7 years to make it through the dip to start the real growth accumulation.
Great. Thank you for that, Willem. I'm just wanting to make sure there's nothing that's definitely centric to you before we move on.
Sure.
Well, can I make a suggestion, Lee? Because there's a couple of questions, well, there's about 6 questions that I want to answer that are here that I'm happy I can answer all of them myself. Could we move to just a closing comment for Willem, considering he's got a hard stop at 9 o'clock, and then I will answer the questions once he's done. I think it'd be quite useful, Willem, if you can wrap up from your side, and then Duck and I'll answer the rest of the questions.
Okay, cool. Thank you for the flexibility. First of all, just thank you for the opportunity again to come to an investor community base and have this sort of frank and open discussion about planning. what we see as the preferable path for rolling out this enterprise. We are at a critical point. We are at crossroads. And I would like us to choose the scaling option and not the one-man show option. I think everyone in the team is aligned for that. And now it's about less PowerPoint and more execution. And what we're hoping to give you is concise, abbreviated information onto the health of the company. And we encourage you for playing an active investor role, and hopefully soon also an evangelistic investor role. My door is open. Please reach out if there are questions, comments, concerns that you think can be addressed. I am very pro engagement and transparency. So please see that as a non-expiring invitation. And then thanks to Lee and Scott for pulling this together. Much appreciated. Thank you for having me this evening.
Awesome. Thank you, Willem. It's a pleasure to have you online, and thanks for all the value adding to the business as well.
Thank you, Scott. A wave good night.
Thank you, Willem.
Lee, do you mind if I just jump through the questions? I know we're running late, but I just want to jump through the questions here. So Gavin said, what sort of buy-in are we getting on the current scaling drive? Again, Willem did ask, what do you mean, Gavin, a market buy-in or investors? I think the good news is certainly from a team perspective and a board perspective is now there's complete clarity. We are trying to communicate with the current shareholders just to understand kind of where we're going and what the plan is. And, you know, obviously more engagement is required in terms of that specific component. And obviously we're working with both Simple and Cedars to ensure that we've got the capitalization to make sure that's a reality. So I don't know if that answers your question, Gavin, but that's certainly our intention. Probably for the first time in the 7 or 8 years I've been attempting to do this, we have finally got alignment at a board and leadership team level as to building a high growth scaling company that certainly wasn't there for many years in the beginning. Danae said, you mentioned an average fee of 2,000 per transaction. Remember, that's an average fee, an average transaction size, Danae. So we'll have everything from someone investing $100 through to people investing $1 million. Our average transaction size over the time the platform's been live is about $32,000, $33,000. Our average at the moment is sitting close to $5,000. So the average transaction size comes down more and more as we drop the minimum investment. But the overall target is to have an average of $2,000. And that's obviously taking people investing at, you know, with time, even $10, maybe even $1, but equally people investing, you know, much larger amounts. Gavin's answered your market buy-in. Yeah, I think, well, hopefully I've answered your question, Gavin. Please ask it again if I haven't. How many transactions do you have at present per year? So last year we topped out at 1,000 transactions, just short of 1,000 transactions. The year before that it was 400. The year before that it was 200. So we're looking to double every year. Our transactions for this past 2 months is already well over 100. I actually need to get the number. Sorry, it's a good question, Denise. I should have it off my fingertips, but I don't. But we're well on track again to double this year, which is our target for transactions. Jing said, will US investors have access to the platform anytime soon? Jing, that's a question that hopefully you will help us answer because it'll require a US partner. So we've done the work. We need a local partner. So it would involve launching the likes of Wealth America with a local partner, and that's what we would call a strategic partner. How much more tech is required to reach the tech objectives of the business? When is enough tech enough to say we're okay and have a system now to make it happen? So we have a system now to make it happen. That's what we were talking about with the value versus the leverage. However, you consistently have to be improving on the tech. As an example, it's a 4-step process. Step 1 of sign up, step 2 of fund your wallet, step 3 of invest are all world-class. Step 4 is still needs quite a lot of work, which is manage your portfolio, etc. So that's an ongoing part. We need to build out an app. As you drop the minimum investment, you need apps. So, you know, there's no ways that a company like Uber or any other technology company does not consistently invest in their tech. However, saying that, there's different stages of the tech, And we've now built up a great scalable platform. That's the value. And now it's time to leverage. And then the tech team can build the next component of value, and then that will need to be leveraged as well. You mentioned the guys in India are shareholders of Wealth India or Wealth Migrate GWG. Now, just to be clear, what I said is there was a shareholder in Johannesburg, South Africa, that introduced us to the partners on the ground in India. We are setting up a strategic partnership with them where we will take shares in the Wealth India organization, but that's a negotiation or a debate. And ideally with a strategic partner, they also invest in the Global Wealth Group holding company. Discounts on share investing, discounts from what? What is the share price per unit to determine the share value? So again, that's the beauty of a safe note. I would highly recommend, we can share with you a video that was done by Simple Capital on the benefits of a safe note and how a safe note works. The whole benefit of a safe note is you're getting a discount off the priced equity round once it actually goes live when you're dealing with institutional capital. And so getting to 1 million transactions per annum is going to be a big ask if we're at 1,000 at present completely, except for the fact that it's the whole beauty is that you double year on year. And also that's organic growth. So remember, our organic growth is to double year on year, but we've got a twofold strategy with bringing on strategic partners. And if you bring on the likes of the partners, just as an example in India that we spoke about, they're looking to target 1.15 million high net worths in the first year. And so you scale through partnerships, you 10x through strategic partnerships, and you consistently grow your organic growth where you're looking to double year on year. And again, what I think is quite important is that today we can actually do 1 million transactions per year, because that's a lot less than 15,000 transactions per second. Lee, any other questions that I've missed? I have tried to. Thank you for clicking on them and making it here. I just want to see there's lots of thank yous.
We do have 2 more questions for you directly, Scott, that have come through. There are 11 attributes of an exponential organization. Which do you feel have added the most to your success?
Sorry, Lee. You just broke up quickly there. The 2 things that have added most to my success or our success?
So there are 11 attributes of an exponential organization.
Sorry, yes, okay. Sorry, yes. Okay. No, for us, it's as clear as day. It's the purpose. It's been the thing that's attracted the incredible people. Patricia Montero just said, yeah, from my experience, it's all about surrounding yourself with the right people who buy into your vision and mission. But above all, it's time for action. As we know that the universe support action, you've had the thoughts, now let's get to the action. We are positioned perfectly for success. Let's do it. I think the point being is that the purpose has attracted both, amazing shareholders. It's attracted people like Willem. When I sat with Willem at the end of last year, one of the things that I really appreciated was I've had a lot of, trying to choose the right word, Lee. What's someone who tries to just feed off you in a negative way? Basically trying to feed off the community that we built through RPS, etc. Parasites is the word I'm looking for. I've had a lot of parasites in my life that have tried to kind of take advantage of what we've built. And it was truly enlightening speaking with Willem when I said, what is success to him? What does winning look like? And why has he joined? And he said, the reason that he's here is that he resonates with the purpose. He truly believes that we should be empowering the 100% to be able to invest. And if you look at it, whether it's our company or even Simple, it's the exact same purpose. So for me, there's not a shadow of a doubt that the purpose is what's attracted not only great people at a board level, at a leadership team level, at an entire team level, and at a shareholder level. And to some extent, even a number of our supply partners are also attracted by it. So by far and away, it's been the number one thing. However, back to Patricia, it's all good and well to have purpose, but like as Willem's eloquently said, now you need a plan to execute. Otherwise, it just remains a vision, a dream, and a hope.
Thank you, Scott. And one last question. What changes do you foresee as you move through the scaling phase with GWG?
I think, Lee, you, me, and Lyndon, as an example, have joked in the past where we are like Swiss Army knives, and we've been able to adapt and find solutions which are very important in that kind of startup phase. I think where Willem is bringing in, I've only ever existed in kind of startup entrepreneurial world. I've never been in corporate world, never, not once. And what Willem's bringing in is a whole professional component at the board level, and then equally bringing that reporting and structure in within the leadership team level, the different business units, including upping our financial capability, bringing in financial resources, etc. And when you ask me the changes that I foresee, I think it's going to be bringing in highly qualified people that have the ability to scale, that have the experience to scale. And then people like yourself, myself, and Lyndon will always be able to add value, because we'll always be creating that next value. However, we're going to need to bring in real professionals to help us leverage the value we've created. And I don't know if I've answered your question, but that's the point that I think we're at now. And that's really, I know that's what Willem's driving at the moment. There's no point in having a beautiful Tesla that sits in the garage that no one knows about. You've actually got to go out and leverage and sell the Teslas.
Absolutely. Thank you, Scott. Couldn't have said it better. There are no more questions that I have seen come through. I have been watching quite vigilantly. So, Scott, closing comments for our attendees.
Yeah, look, I'm very grateful for everyone that's been online. I do hope that all our shareholders watch this webinar, because I think it gives some great insight, and I think Willem gives some great insight. I've only got a sample of one as in our company, so it's very hard to know what best practices without reading it in books. Whereas Willem, as a venture capitalist and as in his previous life at Deloitte, has literally dealt with best practice all over the world. And we really are now bringing that in. And I think not only is there an important understanding around what is required in the scaling phase, but really that investor evangelism and activism is going to be what's required. And I have said this to a couple of shareholders one-to-one. I believe that our destiny, the destiny of the company, lies in all of our hands. It's not just my responsibility or the board's responsibility or the leadership team or the rest of the team's responsibility. It's ultimately going to come down to our collective community. And if we truly come together, I think we're sitting on a generational opportunity. I've always believed that. But now we have to unlock that opportunity. We need to collectively do it together to be able to achieve that.
Thank you, Scott. Before we close off, I just wanted to give the tally of our gifting through B1G1 tonight for our attendees. So thank you to all of those who have commented, added their letters, either a T, a W, or an E. We are going to be donating 49 days of education. We are going to be planting 16 trees and providing 19 days of free water to people in need. So thank you very much for your continued engagement and support. It really is great to be doing more than just sharing with you tonight and you being part of our gifting process. So to our attendees, thank you for spending the last hour and a half with us. We truly value you. We value your comments and your questions. If there is anything else that we can do for you, please do reach out to us. We can set up meetings. We can have discussions with you. So wherever you are in the world, we trust that you wake up every day with your own purpose, that you make a difference, whether it's in your own life.
Sorry, Lee, one quick thing before you shut off. Don't forget the last webinar next week, where we've got two incredible prop tech, fintech investors out of America, one out of the UK and one out of India, with some, please go and read look for the invite, read about I'm not going to sit and talk about all the profiles, but we've got an incredible panel next week talking about the future of the industry. Don't miss it. So sorry, Lee, I didn't want to cut you off, but just before we switch off.
Yeah, that's fine. Thanks, Scott. So wherever you are in the world, we hope that you wake up every day with a purpose, make a difference in your own life and someone else's. Thank you very much. We look forward to seeing you in our final webinar of our Scaling 5.0 webinar series next week. next week, Tuesday at 5 p.m. UK, 7 p.m. South African time. It will not be in the half an hour, but will be on the top of the hour next week. So thank you for joining us. Take care. Goodbye, everybody.